I'm Ron DeLegge with ETFguide TV, and we've got a special guest on today's program. Sylvia Jablonski with Direxion Investments is with us. Sylvia, welcome to the program. It's great to have you with us.
Hi, Ron. Thanks for having me.
Yes, so let's begin with the Federal Reserve implementing a series of steps to deal with the economic fallout from the coronavirus outbreak. And buying bond ETFs has been one of the Fed's boldest moves yet. So how do you see this playing out?
Yeah, so I think it's definitely a bazooka for the markets, and it's almost the thing or the stimulus that we needed to get the markets to have an inverse relationship with the news about the coronavirus. Now that news is now, slightly getting better, or debatably getting better, but initially it was sort of, where do we go from here? Where's the vaccine? Where is the cure? What's the long-term solution? Jobs numbers will be, terrible. The consumer won't be spending. What can we do? And I think the Fed, reacted proportionately to the crisis, and it really did help boost up equity markets, and it also helped boost bond markets. So interestingly enough, I was looking at some of the bond ETFs out there, and they were at massive discounts prior to the Fed making this announcement, and then they sort of started trading back in line and trading at premium. So, I think the market received it well, and the Fed put still works. So we really needed that news.
So during times of high volatility, as we've seen here in the first quarter, investors want stability. They want safety. And the Direxion Flight to Safety ETF, ticker symbol FLYT, was launched in February, which I'd say is pretty good timing. So how does FLYT work, and where might it fit into a person's overall investment strategy?
Sure. So FLYT is a product that we launched because, volatility is really a fact of life. We launched this in February, and obviously, we didn't foresee the coronavirus happening. But we did foresee that volatility would probably come back into the markets one way or another. We were at a pretty long end of a bull market, or seemingly, worried about coming to an end of a bull market. We had geopolitical tensions. We had China trade tariffs. We had, some of the pullbacks on oil and the OPEC disagreements. And then, of course, out of nowhere came the black swan event, the coronavirus, and the product happened to be out in time for it. But what it does is it essentially provides a ballast to your portfolio. So you can view it as a hedge, but the way that we view it is as a way to protect and participate. So what we do is we invest in bonds, gold, and utilities. So basically 3 asset classes that are not correlated to one another, and 3 asset classes that are inversely or not correlated to the market. So over time, what they do is essentially when we get these market pullbacks, they tend to protect the portfolio. They will certainly, in 2008, for example, they certainly fell along with the S&P 500, but the number is far less. But over time, you get that equity participation. You do get a ballast, you do get some protection, but you also get income, you get diversification, and you get the performance of bonds, utility, and gold over time. So it's a really good way to just put a ballast in your portfolio, participate in the appreciation over time, and to get some income.
Another defensive play is to own 1X inverse ETFs like ticker SPDN or CHAD. And for investors that want to protect their long positions without selling them, inverse ETFs offer a nice, easy way to do that. So how are investors using inverse ETFs?
Sure. So there are 2 ways that investors use inverse ETFs like SPDN and CHAD. So SPDN, interestingly enough, it's a great ETF. It's an S&P 500 -1 beta fund. So -1, whatever the S&P 500 does on a daily basis. It's 45 bips. And if you're an RIA and you don't have access to stock loan or capital markets, margin accounts are expensive, where are you going to get a short of anything for 45 bips, particularly in volatile markets? So that product, interestingly enough, like for the last decade or so, it's just sort of been a sleepy product that we have. We always thought it was a great tool. When the market's going straight up, nobody wants to hedge. And coronavirus comes along, and all of a sudden, it's a $100 million ETF because a lot of RIAs and investors wanted to either express their view that the S&P 500 would fall for a couple of weeks or a couple of months, whatever their outlook was. And others just wanted some sort of hedge for their portfolio, because the biggest mistake that investors make in these pullbacks is they just start selling everything. There's like this panic to raise cash. And a lot of times they're recognizing these huge losses, which, most of the time doesn't work out for them. them. It's really hard to catch up from that kind of trading. And I think, sticking a hedge in a portfolio or an inverse view to generate some alpha is a good way to look at it. Super easy to understand. And again, the biggest thing is for a lot of clients out there that don't have access to stock loan, you can buy a stock and be short. So you buy SPDN, you're short S&P 500.
Excellent. Let's move on and talk about the other leverage and inverse products, which I think Direxion is probably better known for, is the 2X and the 3X daily leverage products, which serve short-term traders as well as tactical allocators. But for long-term investors, they can also use leverage too. Direxion has the Portfolio Plus ETFs, which add 35% more daily exposure to popular broad-based indexes from S&P as well as FTSE. So tell us more.
Yeah, so for the shorter term products, as you said, a lot of tactical traders just want to look at the short term opportunity to amplify exposure to an index. So, for the last 6 days or so, NASDAQ, a lot of the FANGs names have just been ripping up, and, TECL, SOXL, their 3X technology, 3X semiconductors, they've really been ripping. They've had, double digit returns for a short period of time, but the VIX is still above 40. There's still range bound volatility. So for the traders who are in those funds, they're probably already out of them. They probably went in for a couple of days. They probably went out of them. So, they're really appropriate for that crowd, the day trading crowd or the short-term trader who, has a view to look at his portfolio every day, rebalance, and actively make a decision as to whether or not he wants to keep it on. So, in a market like this, you don't hold those things for a long time. You trade them actively. Whereas PPLC is, as you said, 1.35. So you get the additional 0.35 beta on a daily basis to the S&P 500, to emerging markets, to some of the other sectors that we offer. And I'll stick with S&P 500 because it's an easy one. Look what's going on now, right? We just talked about it. Asset prices fell. Feels like they bottomed out. Can we retest the lows? Maybe. Earnings aren't that good. But what I would argue is that we are at lower valuations than we were in February. You can never time the bottom of the market. So what do? You trickle in a little bit on the pullback days. If you buy a 1.35 beta ETF, as the S&P starts to recover over time, that extra 0.35 beta gives you outperformance to just having straight S&P 500 exposure. So it's a good way to sort of, catch up over time. And you don't have the same risk that you do with a 2 or 3X product. So yes, if the S&P 500 is down, you will be down more than holding a 1 beta fund. But if it's up, like let's just say from the last week or so, S&P is up, 5-6%, this ETF will be up. Actually, I looked at it the other day. It was 5% versus 6.16%. So you're getting that little 0.35 beta. The compounding and rebalance gives you that little bit of extra alpha in your portfolio as the S&P is rising. Excellent.
One last thing before you take off, Sylvia. It's easy for investors to panic during turbulent markets when everything seems like it's just falling out of the sky. And you sort of alluded to it, but we want to just end with this because I think it's important. What can help people avoid doing the wrong thing at the wrong time?
I think it's a good lesson for all of us. Lesson number 1 is always have a well-diversified portfolio. Lesson 2, you shouldn't be so invested that you don't have enough cash to live on so that you don't have to fire sale. Lesson number 3, I would say is, don't sell. Over the last, 10 bear markets that we've seen, the S&P 500 does recover. Some of the bear markets last a few months and some of the bear markets and recessions last, a couple of years, but they're sort of known periods of time. They're not 10-year periods of time. So if you can hang in there, ride it out, keep the positions in and look for opportunities to buy on the dip. I think, if you have a really long-term holding period, these are also the opportunities of a lifetime, that for the next generation, particularly that might hold a product for 10 years or so, everything has been on sale more or less. But the biggest lesson is, don't take massive losses if you don't really need to. If you can ride it out for a couple of years, markets do tend to recover. These things do tend to pass. Yes, it'll be a bumpy road. Earnings will be bad. Growth will be slower, but time tends to correct these things. So, look for your spots and don't take massive losses if you don't need the cash.
Well, that's great advice, and we appreciate you joining us and taking the time. Again, you just heard from Sylvia Jablonski at Direxion Investments. Go there. I'm Ron DeLegge with ETFguide TV. Thanks for watching.